Good afternoon, and a warm welcome to you, those of you joining us. I'm James Godborough. I'm the MDU Senior Learning and Development Officer, and I'll be helping to facilitate today's session, of which I'm not an expert, but thankfully I'm joined by two experts from Armstrong Watson, and that's Morag Miller and Ben Walsh. So Morag's partner and head of healthcare services, and Ben is a financial planning consultant. Both have an excellent understanding of the NHS, having worked extensively with healthcare professionals throughout their career. We know that recent changes to NHS pensions have left some healthcare professionals unsure how they're affected. Morag and Ben are here today to help clear up some of that confusion. Today's webinar is going to cover a number of different sections. So we're going to talk about an overview of the NHS Pension Scheme sections, what to expect from the McCloud Remedy, removal of the lifetime allowance and what it might mean to you, changes to NHS pension employee tier contribution rates, changes to the retirement options available to all NHS staff. And this webinar is for doctors, is focused at doctors working in England and Wales. It's intended for general practitioners, hospital doctors, training grade doctors and NHS consultants, or of course consultants doing a mix of NHS and private work. Session is being recorded and it's being made available on the MDU website in the next 5 days. Attendees will be emailed an attendance certificate shortly after the webinar. Please do feel free to ask questions. Often if you've got a question, somebody else will be thinking it, so please submit them in the chat. We'll get through as many as we can. So finally, you might be aware that MDU members get exclusive rates on Armstrong Watson's tax, accountancy and business advisory services, and can book a no obligation free 20-minute consultation. So we'll give you a bit more information on that at the end of the webinar, along with details of some of the MDU's learning resources. However, I'm going to stop talking and hand over to the experts, to Morag and Ben, to talk you through this often complex subject.
Thank you very much, James. So the topic today is Be Pension Ready. As we all know, there's been a huge amount of change relating to the NHS pension scheme over recent years, and we hope to touch on some of the key areas that might be of interest to clinicians who are currently in the NHS. The slides, the areas that we will be covering are, as James has just mentioned, and detailed on this current slide. We will be happy to take questions at the end of each of these subsections. So as James has already mentioned, please do put them in the chat and we'll get around to as many as we possibly can. Just a brief overview about Armstrong Watson. So I'm a partner, as James has said. I work with Armstrong Watson LLP. I am head of the healthcare services team. Armstrong Watson has been a company, or sorry, been a business that's been around for over 155 years. But due to the regulatory regime, financial planners can't sit in this part. So the sister company, Armstrong Watson Financial Planning, which Ben is a member of, as I said, I'm a chartered accountant, Ben is a financial planner. So that's just to explain, it's all to do with the regulatory requirements around pension schemes and the provision of other financial services that has led to this. But we're very much work hand in hand. We sit in the same office and have the same clients. So a bit about myself. You probably already have more than enough detail about me. So skimming over onto Ben. I say Ben is a financial planning consultant. He works with Armstrong Watson Financial Planning Limited. And yeah, we're very, very experienced, both of us in different ways around the NHS pension scheme. So I do have to mention that this seminar is purely for information and does not constitute advice in any way. Big disclaimer, because obviously it's a heavily regulated industry. This is for information. If anybody does want to have specific queries answered, we'll happily take one of the 20-minute consultations that James referred to earlier. We'll touch upon it at the end, but please do not place any reliance on what you hear in this presentation. It is for information only. So let's get into the meat of what we're going to cover. So the first area is looking at the NHS pension scheme and sections. Now, you may be aware or not aware that the NHS pension scheme is actually made up of 2 schemes, and within those 2 schemes, there are 3 sections. So there is the 9508 sections form part of the 9508 scheme, and there is the 2015 scheme that was introduced in 2015. Now, each section of the NHS pension has its own rules, and we will touch on those in the next slide. And you'll find it's very common, certainly with the more mature members of the profession, to be members of more than one section. And from the 1st of April 2022, everybody, no matter what your history, no matter what's gone on here, will be a member of the 2015 scheme. Again, the bottom bullet point just touches upon the different type of member. You can be an active member if you're actively contributing to the pension, or you're a deferred member if you've stopped paying but you're not yet taking your pension. And obviously those that are taking the pension are classed as pensioners. So moving on now, Ben will go through the different sections and what those rules are.
Brilliant, thank you, Maura. Yeah, so I'm going to summarise quite high level here the key differences between the legacy scheme rules, which is the 95 and 2008 part of the pension scheme, and then the new scheme, which is the 2015 scheme. So we'll kick off with the 9508. So not only are there two different schemes with the old legacy part, but it's also split between NHS staff such as consultants and medical practitioners like GPs. So the way in which the schemes are administered, so you've got the scheme type for NHS staff is based on a final salary, whether that's 95 or 2008. Whereas with GPs and medical practitioners, it's based on the earnings accrued through their working lives. Now, we also have difference in the accumulation rate. So the pension for the 1995 scheme for GPs is based on 1/80th. So you accrue 1/80th of pension pay per year. And then with the 2008 scheme, it's slightly quicker accrual with a 1/60th. Now, this is different to medical practitioners. And what happens is at the point of retirement, they accrue 1.4% if they're in the 95 scheme of those total sort of accrued earnings throughout their career. With the 08 scheme, again, slightly higher with 1.87. So that's the key differences there. Now, when it comes to other factors which most people find impact them the most is the lump sum entitlements. With the 1995 scheme, you have a statutory or standard lump sum of 3 times the pension at retirement. Whereas, unfortunately, with the 2008 scheme, there is no standard or statutory lump sum. What NHS Pensions allows is the option to exchange pension, so that pension income you've accrued, for lump sum up to 25% of the capital value. Now, this is what you can do this both in 2008 and 1995 if you want to top up the standard lump sum that you have received in the 1995 scheme. This is the same for both NHS staff and medical practitioners. Another key difference between the 2 legacy schemes, the 95 and the 08, is the normal pension age. So with the 1995 scheme, you can access it. The normal pension age is 60. However, with the 2008 scheme, it's higher at 65. And this links to why it's seen as a slightly quicker accrual, like we said, 1/80th versus 1/60th. Now, when we look at the new scheme, the 2015 scheme, they've slightly eased the administration by introducing 1 scheme for all NHS workers. So that's good news. It's a different scheme in a sense, it's a career average scheme. So each year, a pension member will accrue 1/54th of their pensionable pay. Now, this is revalued at the point of retirement, where they will have the treasury rate plus 1.5%. So that means your early earnings in your career won't lose out against inflation over the longer term. Now, with the 15 scheme, it's much like the 08 scheme. There is no standard lump sum, so you have to exchange that pension income you've accrued for lump sums up to the 25% capital value. Another key difference is that they've changed the retirement age again. So now they've linked it to state pension age, so it's currently 67, and this could mean in future years there could be further changes. So that's a very high level overview of the scheme rules and the differences we have here. We're now going to put a quick poll on the page, so if you could quickly complete that. Brilliant. So I hope people have had the opportunity to answer. We'll have a look at the results now. While they're getting sorted in the background, do ask questions throughout. Perfect. So this is good to know. So 89% of people on the call were a member of the NHS scheme before 2012. So why this is important, we'll come on to later, but we just wanted to get this information at the start of the seminar.
Before we move on to the next section, are there any questions?
So we do have a question. There we go. The 95, they're a 95 pension scheme member regarding final salary pension. If I retire in 2025, which will be my final salary for the purpose of pension calculation, will it be the salary in February 22 or the salary in 2025?
So when it comes down to working out your final salary, with the change in rules, salary still going on. So even though you're no longer accruing further benefits in the 1995 scheme, there is still salary linking there. When it comes down to determining exactly what your final salary will be, the salary has to be paid in payment for over 12 months before you retire, and then they look back and then they'll take a sort of pro rata basis of that salary over that 12-month period. But importantly here, even though you've moved to the new scheme, there is still salary linking for that old legacy scheme.
Another question here. Can you describe the earnings accrual bit for medical practitioners?
Yes, so with the earnings accrual, it's quite a complex area really, understanding exactly what you accrue each year. I think this type of question is probably best to book in a consultation, simply because the earnings accrual, you will accrue a certain amount of your pension pay each year, and then there's dynamising factors that need to be applied to that. So if you really want to understand what the pension looks like, it's probably easier to sit down and spend some time speaking about your specific circumstances.
What does the max age mean? Is it the age up to which we can give contribution?
It is, yes.
So quite a lot of questions coming in here, and I'm really sorry if we don't get through all of them. We will try and cover more at the end as well. What are the implications for taking early pension, e.g. at age 55 for different schemes?
Yes, so there are different factors for different schemes on early retirement. We say rough calculations for the 1995, or rough calculations in general, is that you'll give up, say, 5% of that pension you've accrued to take it per year early. Again, something that can be modelled so you can understand the exact implications. It's important to do so if you are looking at taking it early and understanding what is the implication of taking it at 55 compared to 57, 58, for example. Something that I would say always speak to an advisor with.
So now let's look at the public sector pension reform. As I'm sure you'll all be very well aware, in 2015, there was across all public sector agencies, so whether it be the NHS, police, the judicial system, all sorts of public sector, a new pension scheme was introduced, the 2015 scheme, which we've obviously alluded to. However, the mechanism by which this was introduced has been challenged. It was actually challenged by a judge, Victoria McCloud, who was, I think, one of the most senior judges in the country. So she probably thought she was onto a winner when she took the government to task. Basically what happened is when it was introduced, it was very much age dependent as to whether or not you stayed in your legacy scheme, whether or not there was a period of transition, whether you went into the 2015 scheme at some point in this period of transition, or whether you went straight into the 2015 scheme. And I say, because it was age dependent, obviously the government were then taken to task over the fact it was age discriminatory, and needless to say it won. Obviously because it was Judge McCloud that took the case to the High Court, it's quite often referred to as the McCloud Remedy. That's how it actually got its name. But basically the McCloud Remedy is set to undo the injustices that were brought around the age discriminatory ways in which this was introduced. So the remedy's in two parts, and this is where the poll comes to task, because obviously it's to do with when you were in the pension scheme. So if you were a member of the 95 or the 08 scheme in the 1st of April 2012, then this will impact you. And what that means is if you'd then gone into the 2015 scheme, anything that you then contributed between the 1st of April 2015 and the 31st of March 22 will automatically be put back into one of your legacy scheme, whether that be the 95 scheme or the 08 scheme. The second part of the remedy is that from the 1st of April 22, everybody went into the 2015 scheme. Now, obviously, there are those people that joined the scheme after the 1st of April 2015. If they were new to an NHS pension scheme because they were new to the NHS, then they would stay in the scheme as at that date. So it just relates to those people that were in either the 95 or the 08 scheme at 31st of March 2012. And then there is another consideration to be, well, whether or not you use those acquired or accumulated benefits in your legacy scheme or the 2015 scheme is a decision that will be made at the point of retirement. They're known as option A for the legacy scheme, option B if you want to move to the 2015 section of the NHS pension scheme. Again, we'll be touching on those as we head a bit further on.
Brilliant, thank you. Yeah, so just highlighting exactly who might be impacted by the McCloud Remedy here. It's all members in service on or before the 31st of March 2012. So that was 89% of this call. So you can see the broad spectrum of people that could be impacted. Now, not only does it impact the currently active members, but also if you were deferred or you are a retired member, you could still be impacted. So it's really important to understand what are the implications and how could you be impacted. And that's what the next part of this presentation is going to touch on.
Are there any questions?
We have
Sorry,
questions.
James. Keeping you on your toes here, aren't we?
No, you're absolutely fine. Interesting question here. What happens about pension charges that were paid?
If that relates to the pension, an annual allowance tax charge, we're moving on to that, and I'll explain exactly what the implications are here. So that leads us quite on actually to start to roll on the impact of the McCloud and what to look out for. So I've split it up into 3 key areas. So what to expect and what are the potential impacts. We're going to touch on the annual allowance tax position. So that question leads on perfectly. And what is the impact on your personal position there? We'll then move on to the change in the benefits you've accrued. So touching on what Morag said, looking at the legacy scheme compared to the new scheme. We're then going to touch very briefly on 2 niche areas. Contingent decisions, what does this mean? And also pensions choices to reversal. They might not mean much for many people on the call now, but we're just going to give them a very high level overview. Perfect. So moving on to annual allowance. I'm sure lots of people on the call have heard about annual allowance. It was, the hot topic from 2015-16 up until recent times, and it impacted a lot of medics contributing to the NHS scheme. So what I've done here is I've illustrated exactly the annual allowance position for just a medic. I've pulled a medic out of a hat and I've tried to illustrate it here so you can relate to exactly what the position looked like pre the McCloud Remedy. So what the annual allowance is how much you can save into your NHS pension each tax year. Now, when you were pre-McCloud, if you think back, we had the legacy scheme. So for this member, 1995, and also the 2015 scheme, you had 2 inputs. So we can see that illustrated here. Orange bar is the 1995 input, and 2015 scheme is that purple bar. The red line is the annual allowance availability for this member, including carry forward. So what carry forward is the ability, if you don't utilize your full annual allowance for that tax year, to utilize that in future tax years for up to 3 years. So for example, the annual allowance this tax year is £60,000. If your input is £40,000, you would have £20,000 you can utilise at a later date within 3 tax years. So that's what the red line illustrates here. Now, unfortunately for this member, we can see that those orange and purple bars have exceeded that red line. So therefore, there would be an annual allowance tax that this member would need to have paid. This happened to a lot of members, especially consultants or GPs that had been earning, and they were starting to get to the top of their earning capacity. The higher earners were impacted even more substantially. But what we can see here is just a rough example that this member would have had to pay £16,000 in annual allowance tax. Now, post McCloud, what does the position look like? So what we can see is the purple bars have dropped off because there's no longer 2 inputs. It's just that sole legacy scheme input of the 1995, so that orange bar. And good news for this member is that orange bar is remaining below the red bar now moving forward. So this means that this member's annual allowance position is staying below the red bar, and therefore there's no tax to pay. And in fact, that member can claim back that £16,000 that's been paid with annual allowance tax charges. Now, this is just one example of any type of pulled a doctor out of a hat type example, but it just shows you that if you have had annual allowance tax issues in the past, that the position could change and is most likely to change. So it's really important to make sure that this is ironed out and corrected. Unfortunately, NHS pensions won't correct this position for you. If you do have these large NHS scheme pays against your pension, you should look at auditing your position. Are there any questions there before we move on?
Yeah, we've got quite a few here. So when considering retirement, will the options presented include calculations of what pension we will get in option A or B?
Yes, I believe so. Now, one thing to consider is that NHS pensions are still trying to iron out exactly what these options will look like, and they're still building the software, they're still building the statements that you will receive. But yes, you should be able to request an illustration of what the legacy scheme looks like compared to the 15 scheme, yes.
Great, lovely. Can I ask, if you have a mix of medical practitioner pensions, such as a GP, but also an officer, does the officer count as NHS staff?
Yes, so this is a very complex question. Different people's positions are different depending if you have split service. Some people will move that service into one scheme or the other scheme. I would say it depends on your personal circumstances. If you'd like to understand exactly what potential benefits will move in from, say, officer status to practitioner status, it's something we can assist you with. I wouldn't be able to answer over this type of seminar without knowing your personal circumstances. Brilliant, James. Okay, well, we'll touch on the impact to the accrued benefits. So as I highlighted, we saw that the 2015 scheme benefits had been removed. So they've been automatically moved back into that legacy scheme. So that 95 or 08 scheme for all impacted members. Now, this is done automatically. No decision needs to be made by members in the scheme. The scheme do this automatically, and there'll be a statement that you receive reflecting this. Should be arriving by October. Now, like Morag highlighted, you'll be given the choice at retirement. Would you like to keep these 7 years within the legacy scheme, or would you like to take it in that reformed 2015 scheme? Now, there's no one size fits all here, I'm afraid. And when you are looking to determine what option is best, I would say it's really important to understand your personal retirement plans and objectives, and how do these different options fit into your circumstances. We see lots of decisions made that are based on sort of what their friends have done, but it's really important to take a step back from sort of what I call changing room advice and understand these true implications so you can get the most out of that pension scheme. Now, one factor that will probably impact fewer people on the call is contingent decisions. Now, what is contingent decisions? This is looking at for all members that potentially opted out between 2015-16 and 2022. If you opted out, you might have given up added years or partaked in the hokey cokey, which is opting in and out the scheme to try and reduce the annual allowance input. Following the McCloud Remedy, NHS Pensions is giving members the opportunity to reinstate their NHS membership for these parts of these years. For example, if you opted out in 2016 until 2018, you don't have to opt back in for the full amount of time. That might not make the most sense with regard to pension accrual. So it's important to understand say 6 months here, 6 months there, what does that mean for your pension benefits? Because you do have to pay the employee contributions, and these will have interest on. If this is something that you've done, if you've opted out or you did give up added years, I would recommend sitting down with someone like myself to understand what is the true net gain of putting those contributions back in. What is the annual allowance position, and what is the sort of cost that you'll have to face there? So it's a very complex area and it requires advice, but it's it could be a really valuable area that people that opted out should look into. The second part, this will impact even fewer members, is if people under the choices to exercise decided to move their 1995 scheme benefits into the 2008 section, they may be given the option to undo this decision. Now, when looking at undoing this decision, you should really understand exactly what you're giving up, what have you accrued in the 2008 scheme, and what would giving this up put into the 1995 scheme, and what is the implications of doing such. Again, like contingent decisions, it's quite a complex area of pension advice and planning, so I would recommend speaking to a financial advisor or someone like myself who can assist you with this And please note, this is only available to pension choice 2. Unfortunately, pension choice 1 members will not be given this option. Any questions there before we move on?
Yep, we a couple of questions in the chat. I plan to take my 1995 pension scheme at the end of July. How quickly will I get my letter?
So the turnaround to claim the pension is 3 months. Now you should receive, if that's what the question sort of asking there, is how quickly, if you submit your AW8 form, which is the form that you need to submit to take retirement benefits, how quickly will they administer that and send you a letter confirming exactly what pension and what lump sum you're taking? Yeah, that can take up to that should take 3 months there. NHS Pensions Agency typically stick to that, but with everything going on, you never know exactly what could happen.
What I would say with that is, if the gentleman that's put the question forward is a GP, there is often a delay in the type 1 superannuation certificates that need to be administered by Primary Care Support England before they're then passed over to NHS England, and that can create a delay in actually arriving at the final figure. But NHS pensions will always work out what the estimated pension will be based on the information available. They will still award that pension, and when all the information is finally gathered, and it can sometimes take up to years after a general practitioner has retired, then they will correct whether that impacts the lump sum or the pension or both. They will correct that, and whether that means a slightly larger lump sum coming a few years down the line, or unfortunately the converse of that is if they've been overpaid in the first instance and they have to pay back. But they will still get some pension based on the information that NHS Pension has at that time.
Brilliant. I think we'll move on to the next slide there. So I'm sure lots of people saw, following the recent budget, there was a big change to the lifetime allowance regime. Really exciting stuff, as we know. So what happened here was, under the old regime, the lifetime allowance would measure both pension funds that were used to provide that tax-free lump sum that people get at the point of retirement, but also the pension income. And it was set most recently just over that £1 million mark. Now, what the new regime's done is it's decided it's not going to test both of those, lump sum and pension income, but solely focus on that tax-free lump sum payment part. So the new regime will simply test how much tax-free lump sum do you take from your pension benefits. And they've set this at 25% of that old lifetime allowance. So therefore, people have that tax-free lump sum allowance now set at £268,000. As a whole, this is fantastic news for medics, because the pension income part that people take from defined benefit schemes like the NHS pension did make up a lot of that lifetime allowance calculation. So it's really good news. If any medics do have old lifetime allowance protections, these were called individual protection 2016, for example, these are still applicable, and they could offer you really valuable benefits in securing a larger tax-free lump sum allowance. So if you do have these in place, often, like I've said before, definitely recommend seeking financial advice if you're in the process of taking those pensions, to ensure you don't miss out on any really valuable allowances there. Now, to try and explain this a bit easier, I've put an example of what the old regime looked like for a 1995 member compared to the new. So on the screen here, we can see an example. So an NHS 1995 pension member decided to take their benefits under the old LTA regime. This was a £50,000 per annum pension and the standard lump sum, which is 3 times that of £150,000. So under the old regime, this would have accounted for 107% of that standard lifetime allowance. So therefore, not only would they have had a small tax charge to pay on the income above the excess, but they also would have no further access to any tax-free cash from any other pension pots they had. Now, you compare this to the new regime, only that £150,000 lump sum would be measured, and that utilises 56% of that lump sum allowance. Therefore, this member could access up to another 44%, or £118,000 of tax-free cash from an alternative pension pot. So it really highlights how valuable this change in rule was. Not only can they have that new access up to that £118,000, but also if they are a member of, say, the 2015 benefits, 2015 new scheme, they can continue to build this with knowing they're not going to be double taxed on this, say, annual allowance and LTA tax issues here. So it's a really good change of rules for medics, and people need to be aware of this. Also, If there are any medics on the call that did retire and return and have previously taken 1995 benefits, and they've taken, for example, a lump sum of 200,000 or 150,000, there's a way of applying for a certificate that protects the amount, the additional tax-free cash that they could have under the new regime, even if they retired under the old regime. So if this is something, if anyone has been impacted by retiring and returning under the old regime, I would recommend seeking financial advice to make sure you get that certificate before any decisions are made with regard to other pensions, because it's very easy to reverse the opportunity to be able to do this by accessing other pensions without advice.
Before we move on, just one other comment really is, so the government took this out of legislation at the end, last month. It was in legislation, reduced down to 0% for 12 months, and it got removed from legislation. Labour have said that they will reintroduce this should they be elected. So it's one of those things you might just want to be thinking from a timeline point of view when you do want to retire, if it could be over the next 2 years, because there could be quite significant financial consequences of delaying retirements if the LTA does come back in.
Brilliant, thank you. So we're going to just quickly touch on the annual allowance tax landscape. So as I mentioned earlier, the position for members impacted by the McCloud has been completely turned upside down, and everyone's position will change. The extent depends on your earnings and your annual allowance position there. However, as things go, we can see that through from 2006 to 23-24, there's been a lot of change in this landscape, so it is very difficult to navigate. We can see highs of £255,000 that you can put into a pension each year to lows of £40,000, and also the introduction of the tapered annual allowance. Now, what the tapered annual allowance is for higher earners, it's a reduction in the amount you can put into a pension each year. So without getting into much of the nitty-gritty detail, I'm going to illustrate it here exactly what that might look like. So from 23-24, they've increased the annual allowance to the tapered annual allowance threshold income mark of £260,000. But what we can see here, this darker blue line here illustrates at the point you earn £260,000, the amount you can go into that pension reduces steadily down to a minimum of £10,000. So it can be quite a big impact for those higher earners who are still contributing to the NHS pension scheme. The turquoise line below illustrates what it looked like at 40,000. So we can see here how low that allowance went at only £4,000. What I would say is, if you think you have been impacted by the tapered annual allowance, or you know you've been impacted by the tapered annual allowance, you add this to the changing annual allowance position following McCloud Remedy, and it really looks like a very complex area to navigate. So I would recommend, seeking financial advice, sitting down with someone like myself who can really audit that position and make sure everything is corrected. Do we have any questions there?
Right, yeah, we have quite a few. So are there any disadvantages of applying for higher LTA protection now?
So following the change, the LTA the landscape and the regime there, they have put caps on whether you can apply. There aren't any disadvantages as such of applying, but it's whether you can apply and will it mean anything there. Now, part of the McCloud Remedy was that if you have been impacted by it, you can still apply for some of the old LTA protections. So yeah, I would flag, if you think your earnings, if you think your pension value was above a certain amount back in 2016, I think it's around £1 million there, then it might make sense to apply, or at least check to see if it's applicable.
Great. Can you collect your pension and carrying on working without retiring or notifying your employer?
So we're going to come on to that later, so I won't answer that question just now, but it's something that we touch on later. Okay. Perfect. So pass over to Morag for the next area.
Right, so I think anybody who has suffered an annual allowance tax charge will know that these can actually be quite painful. Obviously, we've looked at the mechanism as to how annual allowance can impact individuals. I mean, the NHS pension is a defined benefit scheme, so it's not what you contribute into the scheme, it's the growth in the scheme. So we have the growth in the scheme, we then deduct the amount of available annual allowance, which in the current year is 60,000, less any brought forward annual allowance from the previous 3 years that has been unused, and any excess after the annual allowance is then subject to a tax charge. You will pay interest on any annual allowance excess tax charge. It should be paid with in the past, it's always been disclosed within the tax return, irrespective of how it's been paid. So HMRC are aware about it. If it was a scheme pays election, which we'll touch on in a minute, then there could be a delay in the NHS pensions actually paying that over to HMRC, in which case sometimes interest charges do accrue there. For the McCloud Remedy, the annual allowance tax charges, sorry, 22-23, because of the McCloud Remedy, the 22-23 annual allowance pension saving statements are not available. They're the statements that you need to determine whether there is going to be a likely annual allowance excess tax charge. They're not available because at the moment, NHS pensions are working on the remedial pension saving statement, which is going to be a statement covering the 7-year period and some years prior to that. So everybody that's impacted, everybody that's moved into the legacy scheme will then get a new pension, well, the remedial pension saving statement, from which they will then be able to calculate whether they have gotten an annual allowance tax charge. If they have not, but they've paid it in the past, they can then seek about getting that refunded to them, and there are mechanisms to use around that. HMRC have actually introduced a new online portal to report annual allowance excess tax charges. It's linked to a pensions calculator. Just so you know, the calculator does not yet work, so don't use it. That's my advice. Do not use it. Obviously, you need the statements to work out this anyway. The statements were meant to be being made available from April. We're already being told they're now not going to be available until the 6th of October. Whether that deadline moves again, I'm not sure, because that deadline of the 6th of October is actually set in legislation. So hopefully people will have their statements, and once you have your remedial statements, you'll then hopefully quite quickly then get your 22-23 statement, which is obviously based on your being a member of the 2015 scheme, and then again you'll be reporting that through the new HMRC online tool. If you have a charge to pay and you have not previously had a charge to pay, the good news is that NHS Pensions and HMRC have agreed that you only have to go back to 18-19. So if you've got charges relating to earlier years, they're not payable. You can reclaim them if you've paid them and they're no longer required. You will be able to get them back, and there is an element of compensation that you'll be able to access to get the financial support required to complete all this work. We're not going to touch on that in this seminar, but it is out there. So, you know, again, maybe that could be a separate seminar that we look at holding. It's quite a lengthy process in its own right. But we'll just now touch on the annual allowance tax charge and how you actually can pay it.
Brilliant, thanks, Borak. Yeah, so there's 3 key ways in which you can settle annual allowance tax charges. Now, which one is best for you is very much dependent on your personal circumstances. But what I'm going to do here is just give you a high-level overview of the 3 different ways, just to understand some of the key differences. So the first option is go direct to HMRC using savings, so money in your back pocket, bearing in mind you've paid tax to have this money in your back pocket on, or borrowing, but you've got to be very aware that there's a very, you're taking on debt and there's a cost to that borrowing. But that would mean that you've settled that charge and there's no need to worry about that moving forward. The second option, NHS scheme pays, very popular with medics, is where you settle that tax charge. That tax charge is settled against your pension, and at retirement, NHS pensions will pay that directly to HMRC using money that you've built up within that NHS pension scheme. So this is a debt that they secure against the pension you're accruing. Now, what happens is, say you settle a tax charge in 2021, 22, and you retire 5 years later. Over those 5 years, they will apply interest and also escape discount rate to it. So that means that it's almost like negative compounding, in a sense, that that debt that you've settled against your NHS pension will increase to the point you retire. So you've got to be very aware of that. However, there is no outlay at the outset, and you're paying it with money that you've accrued in a pension that will be taxable. The final option, one that not many people are aware of, is that you can utilize your private pension through a facility called voluntary scheme pays. Now, what this means is, if you have a private pension on the side, such as an old FSAVC or a private SIP that you might have set up years ago, you can pay money directly to HMRC through this pension. You don't have to crystallise it, and it can be quite an efficient way of utilising that pot of money to pay any sort of scheme pays charges that you have. Different pension providers allow it and administer it. It is quite complex when it comes to organising this, but if you do have annual allowance charges you've paid over the years and you want to understand exactly what is the best route to take, do you have a private pension and you weren't aware of this method? Have you been paying it directly using savings but weren't aware of NHS scheme pays? This is exactly the type of thing that we could discuss in that sort of free consultation, because it's very much specific about your personal circumstances.
Any questions?
Lovely. Yes, we have a couple. Will HMRC also apply penalties as well as interest to any annual allowance tax charge?
From all the commentary that I've seen out there, there won't be any penalties applied. As long as you look at correcting your position following these new statements, there won't be any penalties applied. If you get the new statement, bury your head in the sand. There's nothing to say that in a couple of years HMRC won't come knocking, and they will apply interest and penalties at that point.
Yeah.
Great, thank you. With McCloud, does the average practitioner GP AA amount reduce or increase?
So with the remedy period, it's very hard to say. Typically, we're going to see a reduction in the annual allowance position. Hence why I use that example. 9 times out of 10, most people will see their annual allowance position get better, as in a sense, their inputs will reduce, and then hopefully any tax charges they've paid will be better off. So, yeah.
I mean, it's looking at the growth in the scheme, and the growth in the 95 scheme, as Ben pointed out at the beginning, is lower than either the 2008 or the 2015 scheme. So that's why I would expect, if you're going back into the 95 scheme, that the growth in your fund is going to be slightly lower because of the accrual rate, which means that the available annual allowance hopefully will be sufficient to render no tax charge as a consequence.
Further to that as well, if you decide, as we know, the automatic decision is the legacy scheme, but if you decide at retirement in a couple of years' time, actually you're going to put it into the new scheme, they don't redo the annual allowance position. They'll keep it as it was dealt with once it was put back following the remedy period, so at least you know that you don't have to have that headache as well at retirement.
Thank you. If I want to stay in the 1995 scheme for the 7 years 2015 to 2022, will I have to pay any extra into the 1995 scheme?
Only if you've opted out at any time and there's a shortfall. If you've been actively contributing to the NHS pension scheme throughout the whole period, all that will happen is that the contributions for all that period will just move into the 95 scheme. I mean, that takes us quite nicely onto the next slide, really, yeah. Because the contributions that people pay, as you know, that's the pain that people pay on a month by month basis, is when they get the pay slips and they see the amount that has been deducted from their pay into the NHS pension. But this doesn't really link to the growth in the scheme particularly. This is more about funding the NHS pension for those that actually have retired. And recently there was an actuarial valuation done, which has led to a revision in the rates. So I'm sure for some it'll be very good news that the top tier is actually reduced. So on the 1st of October 2022, we saw the rates that were in place prior to that had been in there since 2015, were actually reduced to the green phase 1 elements, and we can see that they started, if your income was above 13,246, you'd be paying 5.1%, and then they went all the way up to 13.5%. Prior to that, the highest tier rate was 14.5%, and when they were introduced on the 1st of October 22, midway through the NHS year, which was obviously a nightmare for people doing type 1 and type 2 certificates at the end of that period. But they did say that they were hoping within 12 months of then introduced phase 2, having realised the additional work associated with introducing a revised tier rate midway through the year. They actually brought out the consultation to introduce phase 2 earlier on this year, and that phase 2 as well. Obviously, it got consent and it went live on the 1st of April 24. So as I say, anybody that had previously been paying 14.5% will have potentially seen a reduction to 13.5%, and again we'll see a reduction to 12.5% from the 1st of April onwards. But there is a minimum. Let's say there was an actuarial valuation that was undertaken, and there is a minimum amount of money that the government does need to gather from all members of the NHS pension to make the pension affordable. So if you go to the next slide. So what we've also seen is not only there is an overall decrease in the employee tier rates, but the employer tier rate has actually increased, and quite significantly. Now, what a lot of people might not have been aware of is that there was the rate for years was 14.38%, 0.08% of that was administrative charges, so it was 14.3 was the actual contribution that got paid over. In 2019, that was actually increased to 20.6%, but the difference, because of COVID and everything, the Treasury, NHS England, Department of Health agreed to pay the difference, and which meant that a lot of employers and providers continue to pay the 14.38%. On the back of the latest actuarial valuation, employers' rate is now going up to 23.7%. So again, another significant increase. Now, for the time being, NHS England, Department of Health, have said they will continue to fund the difference between the 14.38%, which a lot of employers will pay, and the higher value 23.7, which is the ultimate figure that needs to be paid over. But I mean, I just really want to say that, you know, we don't know how long that is going to go on for. We do know that in Scotland and NHS Scotland have actually already passed that additional cost over to the employers, but they're in discussions at the moment as to how they're going to reimburse primarily GP practices, I guess, around that additional cost. It's not an issue in NHS England at the moment, but moving forward, it's just something to be mindful of. But that's, say, on the whole, people should be financially better off with the change in employee tier rates that have come in from the beginning of this month. Any questions on tier rates?
Nothing specifically on tier rates necessarily. I have one who says, I was contributed to added years in the 95 scheme, which I'm told has now ceased when I switched to the 2015 scheme. Is there anything similar that can be continued?
There is the option to purchase additional pension in the new scheme, 2015 scheme. Now, you need to look at affordability, annual allowance impacts, and the overall sort of your objectives there for building additional pension. But yes, you can buy additional pension in the 15 scheme, either through lump sums or monthly contributions.
Was there a change to annualisation also?
There has been a change to annualisation again so historically, if you only worked for a few months in the year, you'd have to annualise somebody's salary to work out what tier rate they fell in. That has changed from the beginning of April, so moving forward it will purely be your earnings that you're then the tier rate is based on, and so there'll be no annualisation, which is, yes, if you're working only part of the year, is a much better solution for you.
Thank you.
Brilliant. So we'll pick up the final part of the seminar, which is looking at the new flexible retirement options. So I'm sure many people have heard the term retire and return used. That's what people used to do in the past. Now, there's been no changes to these rules. And the key part here is that you must take a break from work, and also you return to work on a new contract. So that's important to know. Looking at the new flexibilities and what do they mean? So following the new rules, they allow people in the 1995 scheme, alongside the 08 and 15, which this was already applicable to take between 20 to 100% of those benefits and continue working. Now, importantly, you don't have to leave your current job, and you don't need to change your contract. So there's no loss of tenure there, which is one of the things which retire and return a lot of people had to face, and the fact that was lost. Now, also a really big positive here, especially when you think about the changing lifetime allowance regime, is that you can continue to build pensions in that new 2015 scheme if you take the old legacy scheme as part of this partial retirement option. A key rule here is you must reduce pension pay by 10%. Now, what does that mean? That depends on your trust and how your trust administrator So if you are looking at doing this, you need to speak to your HR department with regard to how they administer that. Another factor that was introduced is pensionable re-employment. So if you did retire and return and you took your 1995 scheme, you can now rejoin or join the 2015 scheme if you hadn't joined, if you weren't part of that scheme before. So that's really valuable when you think about the impact of that lifetime allowance change. Also, for anyone that has maximum service in the 95 or 08 scheme, you can now solely join the 2015 scheme moving forward. So again, another valuable way of building benefits in that new scheme. So it's good news as a whole for people. And I would say if you are looking at partially retiring and you want to determine exactly what should I take, 20% to 100%, I would say take a step back, understand the implications of taking 20 to 100% and understanding how that fits into your personal circumstances, making sure you get the most out of that pension you've accrued. Brilliant. So that brings us to an end of the seminar there. If there are any more questions, James, would you like to fire those up?
We actually had one that was submitted before the session, but dovetails nicely into your previous slide about flexible retirement options. But the question is, under the partial retirement policy, the employee is allowed to take partial retirement at 60 by reducing PAs by at least 10% in the next 12 months. What if the trust doesn't agree to reduce to more than 10%? What should the employee do?
Well, that comes down to your sort of job plan and the HR department of the trust. So I would say if the trust are saying that you're not allowed to drop further PAs, I would definitely flag that and say that you need to speak to either the management team there or the HR department.
Thank you. How do you calculate 10% reduction as a GP locum?
Be averaged, I would have thought.
It's
average.
Average commitment.
Yeah.
Thank you. And there are an awful lot of questions, and I'm really sorry to everyone if we've not got to your questions, because obviously we've got a limited amount of time. And we've just been asked, could you share the slide with your contact details and email addresses? Again.
Yes, of course.
And I think we've probably got time for one final question. If you retire and return, how long is the break required?
If you retire and return, it's 24 hours. There used to be a rule where you could do no more than 16 hours a week for 4 weeks after retirement. They abolished that, but you still do need to have 24 hours. So it's quite often referred to as 24-hour retirements, but you then can come back on a similar contract that you did previous. But obviously if you were a GP partner, for example, going down that route, you would need to get your partners to agree to take you back into the contract and back into the partnership, whereas the partial retirement, that's not required. And that's one of the main differences, really.
Great, thank you. I am sorry if we don't get to other questions. We may well do a follow-up session to this because there's a lot of questions and probably enough to warrant doing another session. But what I'll do is in a moment, I'll give you details of how you can get in touch with Ben and Morag. But first, I just want to talk to you a little bit more about learning resources for MDU members. So MDU members can access a whole range of learning resources, and it helps them deal with the demands of clinical practice. We run courses and webinars all the way through the year. I have a bit of a vested interest because I run some of these courses. We've got 4 coming up that we've got dates for. So we've got managing conflict between doctors and patients, unconscious bias in healthcare, managing conflict with colleagues, and also an introduction to communication skills. And if you're interested in the communication skills aspect, we have a teaser for that almost, which is our communication skills webinar, Tale of Two Houses, which is coming up on the 15th of May. We've also got a session similar to today on consent and the McCloud judgment. That's on the 4th of June. Please do go to our website, have a look on the mdu.com to see what's available. We also have, in addition to this, our medico-legal seminars, and they can be delivered virtually or at your hospital or group care GP practice. These are completely free to members, and non-members can come along. They provide a really, really valuable opportunity for reflection and discussion about the stuff that people phone us about. we are constantly expanding our suite of member-only e-learning resources, and a lot of what we produce is guided by our members who phone us up often with queries. If you want more information, see a full list of the seminars and e-learning modules, visit our website. So as I mentioned at the beginning of the webinar, MDU members get exclusive rates on Armstrong Watson's tax, accountancy and business advisory services. So if you've got a specialist, an inquiry, specialist medical accountants are there to support you. So you can book a no obligation free 20-minute consultation, and you can use the QR code that's on screen right now. I'll give you a moment for that if you want to get your phones out. If you're old school, you can email healthcare@armstrongwatson.co.uk. Just let us know when you're contacting us which aspect you'd like to discuss, and we can get you to the most appropriate expert. You need to quote your MDU membership number to access the service. And finally, if you're not an MDU member and you'd like to find out more about the benefits of membership and how we can support you, please do go to our website at themdu.com. Please scan the QR code that's on screen now. That really just leaves me to thank Morag and Ben for bringing your amazing expertise to this really complex subject. Thank you for sharing your knowledge, and thank you for speaking with us today.
Our pleasure.
Pleasure.
Thank you.